Question number 3. Suppose that the dividend yield is 6%, depreciation is 12%, and the corporate tax rate is 35%. What would be the marginal cost of each dollar of machinery investment under the following situations? A. Firms are allowed to expand the machine. Okay, so let's take a new sheet. So this is 3A. Now firms fully deduct immediately. So firms basically can fully deduct the expenses from the machine immediately. So this reduces the cost of investment by $35 for each dollar which is spent. Yeah. So cost of investment is reduced by 35, not $35, but 35 cents, so $0.35 for each dollar spent. And the reason is because if you can deduct the expenses immediately, you save $35, 35 cents for each dollar that you invest in taxes. So therefore, the marginal costs of the investment is depreciation plus dividend yield. But reduced by the tax benefit. So it means that the marginal cost for each dollar of investment is then the depreciation rate, which is 0.12, plus the dividend rate, which is 0.06. And this we multiply with the dollar that we invest minus the taxes that we can deduct, which is 0.35. And this is equal to $0.117. And this is the marginal costs of each dollar of investment if you're allowed to expense the machine and you deduct it immediately in the first period. So sub exercise B. Here we have a tax or investment tax credit. Investment tax credit of 8%. So this will reduce the cost of investments even further. So costs of investments can be reduced even further because now the net cost to the firm is given by the following. So it's depreciation, 0.12, plus the dividend yield, 0.06, times 1 minus the, okay, it depends whether you're, so in this scenario, whether you're allowed to expense the machine or not, because it's not clear from the exercise whether you're allowed to expense the machine under this situation in sub-exercise B or not. So let's assume you can, in addition, allow to expense the machine. So then it's 1 minus 0.35 minus then the investment tax credit rate. So it's 0.08. If you wouldn't, like, if you wouldn't allow for the expense of the machine, you would cross out this year. But let's assume that you can all still still expense the machine, the investment, the dollar that you invested. And if you calculate this, you end up with 0.1026 dollars. So for each dollar that you invest, the marginal costs here are basically roughly 10 cents. And this finishes exercise number 3. So exercise number 4, suppose that the corporate income tax rate is 30%, the personal income tax rate on dividend income and the interest tax rate are both 35%, and the capital gains tax rate is 20%. Compare the after-tax returns on each dollar of corporate earnings under 3 investment financing strategies. Yes, so if you think about companies, there are several ways in which they can raise capital in order to conduct their investments. So they can, so if they have equity on their own, this is one way. They can go and get money from shareholders by emitting shares of the company. So this is equity. Then they can borrow money from banks. So this is debt. So they can buy or sell bonds, which give some fixed interest rates for each year, which is determined in addition to the the payment of the debt itself. And those are different ways to finance your company. And depending on the tax system, there are basically cheaper ways to finance your investment than others, obviously depending on what the tax rates in your country are. And we will now go to 3 different cases for this example here. So in sub-exercise A, the corporation is financing using debt. So when it's using debt, so when this is sub-exercise A, when financing by using debt, so basically the company is selling bonds to, for instance, banks, and they are getting interest rates in returns to the money that they lend to the company. So when financing by using debt, the company pays interests oops, this was wrong. Let me write it again. Interests to bondholders, so for instance the banks, and deducts the interest payments from its taxes. So the consequence of this is, so since it's paying interest to the bondholders, it kind of doesn't pay taxes on the dollar which is invested, because it will pay interest to the bondholders, and the bondholders will pay taxes in a form of the capital gains tax rate. Oh no, sorry, the interest tax rate. So for each dollar which is earned and paid to bondholders as interest rate generates a tax deduction for the firm, for the company, which means that no taxes will be owed for the dollar, for each dollar, at least from the company. But the bondholders, so the banks, must pay 35 cents for each dollar interests that they receive. Okay, so here in this example, the company does not need to pay any taxes for each dollar earned because it's paying interest rates, which can be used as a deduction. And the bondholders, which when they earn $1 of interest rate payments from the company, they have to pay the interest tax rate, which is 0. So it's 35 cents basically. Okay, sub exercise B. The corporation finances by issuing equity but does not pay dividends. So in this case, there is no kind of, at least for this the time interval that we're looking at, it's taking the profits, but it's not paying dividends. Yeah, but so what's basically happening then, if it's keeping the money, is that it has to pay corporate tax rates for each dollar in profit that it's earning. So this is B. So when paying no dividends, the corporate or the company pays 30 cents taxes for each dollar earned. Now, if the profits increase the value of the firm, the shareholder will eventually pay the capital gains tax, because once they sell their shares and they increase in value, they would have to pay this capital gains tax. Eventually pay capital gains tax on the remaining 70 cents. So if we subtract the 30 cents of taxes that the company has to pay, then from $1 of profit, what's remaining is the 70 cents, which is then basically if the value of the company increased, this is kind of what to some extent the shareholders will receive if they're selling the shares. So what they pay is so on the remaining 70 cents, and what they pay is basically 0.7 times 1 minus 0.2. Yeah, so this was the capital gains tax rate. So this was 20%, and this is 0.56 cents. And this is the net gain of the shareholders if the company is increasing in value. If it's not, then we can ignore this and just pay like attention to the fact that 30 cents of taxes are paid for each dollar earned if no dividends are paid out by the company. Okay, this brings us to the last sub exercise for exercise 4. So now the corporation is financing by equity and pays all its income in dividends. So all the profits are paid out in form of dividends. So if the company pays dividends, it must pay taxes on the dollar earnings on each dollar earned, and the shareholders pay taxes on the dividends. So first, each dollar of earnings is reduced by 30%. So each dollar earned, each dollar is reduced by 30% because of the tax. So which means that there are 70 cents remaining. And the second, if the full 70 cents would be then paid out to stockholders in forms of dividends, then they would pay let me just check again what the amount was, the dividend income tax rate, which was 35%. So stockholders then would get 0.7 times 1 minus the dividend tax rate, which is 35%. And this is then equal to roughly 45 cents. And that's what's basically remaining for the stockholders if they would need to pay taxes on dividends, and actually the company is paying out all its income in dividends in the first place. And as you can see, when you compare this to the gain that they would have if they would there would be an increase in the company value and they would not pay any dividends to them, but they could sell their shares, you see that they would get much more. And yeah, this is basically to show that depending on the financing structure of a corporation or a company, the end result, so the profits or what the value of the firm is basically depending on this. And this finishes exercise number 4.